Hello, clients and friends. My name is Manny Chinche, and I am a senior advisor here at the Advisory Group. Also speaking is Brent Beverly, the president of the Advisory Group, along with Chris Lee, the vice president of the Advisory Group. The three of us are certified financial planner practitioners, CFPs, and wealth advisors at our Diamond Bar, California office. Now, we believe an informed client is our best client. And as you watch this, please keep in mind that it is a review of the months of October through December of 2025. 2025 marked the third consecutive year in which equities delivered double-digit returns. This extended bull market was powered largely by three federal rate cuts during the second half of the year, robust AI-driven technology earnings, and broadly positive investor sentiment. Now, during the fourth quarter, investors continued to see new highs in major U.S. equity markets. The S&P 500 gained 2.4% in the fourth quarter, closing 2025 at 6,845, marking a roughly 16% gain for the year. The Dow Jones Industrial Average closed the quarter up 4.5%, ending at 48,063 and up approximately 13% for the year. But during the fourth quarter, inflation continued to show incremental signs of easing, while economic growth remained resilient, contributing to an environment often described as the Goldilocks scenario. Now, this balance of moderating inflation and steady growth helped maintain investor confidence throughout the quarter. Now, the November core CPI, which does not include food and energy prices, was cooler than anticipated by analysts, increasing 2.6% over 12 months. Interest rates were lowered twice during the quarter for a total of 50 basis points in the fourth quarter, ending at 3.5 to 3.75%. Including that September rate cut, 2025 brought a total of 3 consecutive rate cuts. Now, the Federal Open Market Committee ended the year forecasting future rate cuts in 2026. However, they did indicate they could come at a slower pace than we experienced in the last half of 2025. Now, the fourth quarter of 2025 was relatively calm for the U.S. bond market. As the quarter ended, the 10-year Treasury yielded 4.18%, 5-year Treasury was at 3.73%, and the 30-year Treasury yielded 4.84%. Bond behavior continues to hinge on the direction of interest rates. Should the Fed pursue additional rate cuts, existing bonds could appreciate in value. Conversely, the expectations of slower easing or persistent inflation pressures could push yields higher. Now, bonds can be an integral part of a well-diversified portfolio and usually offer stability during times of market decline. However, please remember, while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against a loss. Safety comes with a cost, and many major banks are still only offering low interest rates to savers. According to Barron's, the average bank money market rate on December 29, 2025 was just 0.52%, and the average 12-month CD rate was 1.9%. For anyone who's interested in exploring sources for better interest rates, please contact our office. Now, to take us for the next steps, allow me to bring in Mr. Beverly. Brent, take it away.
All right. Thank you, Manny. Well done. I appreciate it. So let's take a look forward to 2026 now. I want to remind you that no one has a crystal ball that works. Now, that said, most strategists expect the bull market to continue. It was very positive at the beginning of this year. Analysts are optimistic about 2026 with a consensus that year-end returns will be positive. However, investors need to be aware that market pullbacks occur on an average of every 18 months, so we must be prepared. Now, 2026 is also a midterm election year, and this historically created increased uncertainty as investors assess potential changes in congressional control and their implications for taxes, spending, regulations, and so on. While investors are optimistic, as Manny noted earlier, market volatility is likely to persist. We're seeing some of this as this presentation is being recorded. This makes discipline and perspective essential for the long-term investments. The chart you're looking at here is 2025, and if 2025 taught us anything, it's that during challenging times, it's best to avoid emotional decisions. Although history is not a forecast of future outcomes, in 2025, the markets looked pretty good despite that big downturn that you're seeing March and April timeframe. Now, when we look at a historical perspective here, we want to remind you that as we encourage long-term investing, markets go up and down. But if you examine a 45-year chart of equity returns like we're doing here, we're once again reminded that over a 40, a 30, or a 20-year time frame, even with some very severe downturns, historically, long-term investors have been rewarded. So we even look at the 10-year. Guys, give it time. It works up and down, but we're convinced over time, markets will work their ways out. In summary, equities continued to reach record highs in the fourth quarter. The rally was primarily fueled by additional monetary policy easing, the AI boom, the resilient labor market, and consistently strong corporate earnings and profits. In the fourth quarter, the Fed reduced the federal funds rate twice by a total of 50 basis points, finishing the year at a range of 3.5% to 3.75%, with the potential for additional but slower cuts in this coming year. Inflation numbers came in better than expected, and the Consumer Price Index rose less than expected. It's still not meeting the Federal Reserve's 2% target, but it's getting better. We enter 2026 with optimism, but we always need to be prepared for a pullback, even if it's along the way. Overall, investor sentiment was healthy and continued to be positive in the fourth quarter. In conclusion, while we're optimistic, we will continue to monitor potential disruptors, including a slowing economy, the effects of new tax legislation, the path of inflation, interest rates, and what we generously call heightened geopolitical uncertainty. All those things that are going on around the world. But remember, we're here for you. Please reach out with any questions or concerns. Your financial well-being is always our priority. As your financial stewards, we closely monitor areas that we believe are important to your financial well-being. We will keep you updated on developments that could impact your personal situation. Now, please pause and take your time to read through these important disclosures. All right, this is our contact information down at the bottom. We'll give that to you here in just a minute. We are thankful for the opportunity to assist you with your financial needs and your fellow investors. Remember that our firm, clients always come first. Your health and well-being is always our highest priority. One of our major advantages as a financial industry firm is that the advisory group's team, the advisory group, TAG, we like to refer to it as our TAG team. We're very proud of our TAG team and the high quality service we all provide. So here's that information for you to reach out to us. We're glad to be of service. Please reach out to us if you have any questions, comments, or want to meet with us. This concludes our presentation. Be sure to sign up for our next live webinar to welcome you to 2026, which we're giving on February 18th at 6 p.m. Have a wonderful day, a fantastic year, happy, healthy, safe, secure, and prosperous. Thank you so much.